Tom Lee, he's back. Everybody's favorite bull, Tom Lee, is back out on CNBC. New little 4-minute interview we're going to watch and react to in this one here today, folks. Tom Lee, everybody's favorite bull. It seems like every time he comes out, he believes the stock market is going to go up a whole lot in the short term, and he makes some pretty outlandish calls on this one. So we'll react to that one, give my opinion on that one. And then to balance it out here, because we got to balance it out, Sandhills Brenda doesn't see more upside for big tech. So, we'll get a little bullish side, we'll get a little bearish side, we'll be even as all things in life should be, and kind of hear those perspectives, and I'll react to that and kind of give my 2 cents on all of this. I appreciate every single person that subscribed to the channel. I think we're 23,300 subscribers strong now. Like, it's just incredible. So thank you every single person that has subscribed to the channel. I appreciate y'all. And also, just so you know, 2 days away from the epic once-a-year Valentine's Day sale we do for Becoming Master of Stock Market and Dividend Investing Mastery. If you want that deal, shot to your inbox as soon as it drops. Check out the link in the description area. And also, everybody in the Patreon squad, which now we're at 662. We're up to 600 plus Patreons now. Holy smokers, that ain't no jokers. Just so everybody knows that's in there. That's part of that. I just posted my new buys in there, and obviously I post those every single Friday. So if you're interested in joining us in there and supporting the channel, that will be linked in the description as well. I appreciate everybody. Let's get into this.
Tom Lee of Fundstrat Global Advisors, right here on set with me. It's good to see you. Welcome back.
Great to see you, Scott.
That's the headline we're going to start with, 4,800 by year end. I want you to tell me how.
I think if I had to say market internals, it looks like it's baked in the cake in the sense that markets that make this much progress by day 26, 16 out of 17 have been over double-digit returns, and with an average gain of 26%. So I think that the market's revealed its hand. From a fundamental perspective, I think the narrative is inflation is becoming less of a risk to the upside. And from a Fed's perspective, that's a more predictable Fed. I think that allows volatility to come down. I think multiples expand and earnings hold up nicely, and we get investors buying stocks, buying the dip again.
Okay, so I love what the show before us did right off the top. The way they put the debate, don't fight the Fed versus don't fight the tape. The Fed is still highly engaged, okay? You obviously are saying don't fight the tape. The signs in the markets at this point, at the beginning part of this year, tell you that none of the other stuff matters anymore.
Now, this 4,800 call is huge. Just to give you some reference on how big that is, because he's talking about 4,800 by year end here. If we go ahead and pull up the indexes, right? Indexes, and we go to the S&P 500. S&P 500 is sitting, at less than 4,100 right now. So he's talking about 700-point climb here. 700-point climb. That's basically right around to, if I recall, we topped the market around 4,800, and that was at the very end of 2021. Very end of 2021, very beginning of 2022, we topped the market. I think that was right around 4,800. So basically, he's predicting we're going back to all-time highs this year. That's his prediction.
Inflation's coming down enough. There are too many good signs in the market to go back now?
It would be unprecedented, Scott, and just in terms of internals, because we've had such a breadth expansion and the market's producing this much upsides in such a short time. It's never happened in a bear market. But when investors say don't fight the Fed, I think that they're forgetting that there's not just, Fed is not a binary mode. Fed's not just cutting or they're hiking. There's also the Fed that's trying to gradually and be predictable in monetary policy. That's the Fed of the 90s. The Fed was raising rates really for almost 10 years, and the stock market had double-digit gains. So I think predictable rate increases is not the same as...
Listen to that.
The Fed was raising rates really for almost 10 years and be predictable in monetary policy. That's the Fed of the 90s. The Fed was raising rates really for almost 10 years, and the stock market had double-digit gains. So I think...
That's something investors get false time and time again. They assume that if the Fed has rates a little higher, or if they're raising rates, like the stock market can't go up, the economy can't do well. It's a false assumption. We've seen it throughout history many times where the Fed's got rates high, the Fed's raising rates, and the stock market does just fine, and the economy does just fine, right? Doesn't mean that's always going to be the situation, but the fact is, if you just think, oh, the Fed's raising rates, everything's screwed. No, that's not the way this works. It's never been the way this works.
Predictable rate increases is not the same as the Fed wanting financial conditions to tighten to lead to a recession.
What if they're still unpredictable, right? That jobs report was pretty hot. What happens if the CPI is as well? What happens if subsequent inflation reads are not as good as we think they're going to be? I feel like things are still a little uncertain to be, as Jamie Dimon would say the other day, it's too early to declare victory.
You're right. It's too early to declare victory, but there's a difference between the Fed reacting to every data point versus a Fed that wants to be predictable. It took 3 good inflation reports before the Fed even started to use the word disinflation. But from December to February, they went from 0 citations of disinflation to 13. So if the February CPI report is a little bit hot, which we don't expect, we actually think it's going to be another downside read, so that'll be 4 to 5 consecutive months. That's a predictable Fed. We had one somewhat hot jobs report. If the Fed starts raising rates there, that's a Fed that's reactive to data points.
But they're telling us to this point, aren't they, that they're going to be data dependent now? They're not on some predetermined path like some in the market had feared they were at one point. They actually suggest they're going to be data dependent.
Yeah, but there's a difference between data dependent and data reactive. I think the one thing that's going to be important is for the Fed's reaction function to make sense. I think most of us would agree a lot of the economic data that they cite, CPI and jobs reports, is backwards looking. I mean, for instance, high frequency data showed inflation was weakening since June, but the first good inflation report wasn't until October.
Walgreens. Hey, I might have bought some Disney. Did I buy some Disney?
And then it tanked since then. The Fed hadn't even talked about progress on inflation until February of this year, another 4 months later. I think if they're going to start to talk about jobs reports as the reason to move monetary policy, it is a little backwards looking because jobs is the last thing that reacts to monetary policy.
It may be backwards, but they're clearly focused on cracking the labor market, right?
I wish they would have played out that whole segment because he got some other good points in there, right? But in terms of that call, right, 4,800, do I think that it's realistic for this year? Okay, I would call it lower possibility. I would call it I would say like a 35% chance we end at 4,800 or higher on the S&P 500. So I definitely think it's a possibility. At a 35% probability, I'd put it at. But in order to get that, let's just be very clear. We're going to have to go full bull mode. We're going to have to pull all these bears, all these cautionary people over to the bullish side. The only way we do that is CPI for sure dropping, okay, and dropping substantially and eventually going under the 3s over the next 6 months. We'd have to get a situation where the Fed obviously starts potentially even cutting rates, to be honest, because they're looking at the data and they're saying, oh, inflation's coming in. For sure stopping, but it may be even potentially starting to talk about cutting rates, right? And we'd also have to be in a dynamic where earnings start coming in really, really strong. In second quarter, companies start reporting that third quarter is going to be really good. If we get that, it's definitely a possibility, right? But you need a lot of things to kind of go right here to get 4,800. I think 4,400 might be a much more realistic target for the bullish side than something like a 4,800. That's definitely out there. Like I said, it's a possibility, but we're going to need a lot of things to go the bull's way in this whole situation to get a situation like that, right? And we need nothing dramatic bad to happen, which 2022 we got a ton of dramatic bad things to happen all simultaneously, and it was this is worse, this is worse, this is worse. If we can stay out of that, then we're talking, and that might actually be a possibility. Okay, next video up here, why this person does not see any more upside in big tech. Interesting perspective, because I might have a little different perspective. Let's listen to what they have to say here.
Here in Silicon Valley feels nothing like what the stock market looks like within tech. It still seems incredibly vibrant. But I do think when we think about can this trade continue, that
was not where I think she just thought she was going with that, because obviously tech stocks have come back recently. So I thought she was going to say it's down and out here in Silicon Valley. And it's super disappointing and it's like depression. But she went the opposite way. She's saying it's vibrant in Silicon Valley. Right?
Valley feels nothing like what the stock stock market looks like within tech. It still seems incredibly vibrant. But I do think when we think about can this trade continue, we have to really look at what's happening right now with multiples. We've had a really nice move in the market so far this year. It feels really nice after last year. But I think we're going to be limited in terms of the multiple that people are willing to pay in this environment where interest rates are still rising. So we've had such a strong jobs number recently that I think the Fed is going to continue raising rates. And so I think that's going to continue to put a lid on valuation multiples. So it's just hard to argue for a lot more expansion from here. But it certainly has been nice to see, somewhat of a
What she just said there, let me be very clear for everybody watching this, because this is extremely important, especially for anybody that's a long-term investor, okay? What she said is important, because that would be the ideal situation. The ideal situation is actually a lot of the big tech companies come in and report really exciting earnings as the year ticks on. Really good earnings growth, good margin growth, right? Good even potential revenue growth. And they don't really see any tick up in the stock price because people don't want to give them any sort of valuation move up, okay? And so the best situation is those stocks kind of stagnate while their earnings are getting better. As along, that's the ideal situation. The ideal situation, okay? The worst situation is if earnings are getting worse and stock prices are going up, okay? And so if you could have the opposite dynamic, don't fear that. Wish for that, actually, okay? So I just want to be clear about that for everybody that's a longer-term investor. If you're a trader and you're trying to trade in and out of these stocks every day or every week or every month, that's a whole different dynamic. For the long-term investors, actually, you should almost kind of wish for that situation.
A recovery here in stock prices, and many tech names, not the big large cap tech names, but many have been down 70% or more. And so I think some of that was just overdone. So nice to see a little bit of a correction here, but it's just really hard to make a case for ongoing improvement from here in terms of stock prices.
Weiss, I got the 10-year at 372. Long duration assets, so-called.
And to finish out my thoughts here on kind of that big tech portion, I don't know if anybody else can give their opinion here, but in terms of that, I think you really got to divide this big tech up. I think everybody wants to put all of those stocks together. Meta has a lot more upside, to be honest. Tesla still has actually a lot more upside ahead. Shopify actually has a lot more upside ahead. So you have certain stocks. PayPal has a lot more upside ahead that you would kind of put in that big tech category or somewhere around there that actually have significant more upside. Apple, upside, it could be there if they feel like in the back half of this year business is going to come back and they start talking about that. That one might be a little lid on it. Microsoft might be a little lid on it. But Google's in a kind of a messy situation, so that one's I don't know what to expect out of Google, to be quite honest. But, I think you really got to divide these big techs between the ones that got hurt the most significantly in 2022 still have a long way to run, not just this year, but in future years than maybe some of those top dogs that, they got hit, but not nearly as hard.
Duration assets have been hit as rates have gone up. Did we put a cap on that trade that had
Amazon's got a long, long way to go.
Gotten off to a great start this year? Because I'll give you some numbers of stocks this week alone after you answer that question.
Yeah, so I'm still short. I'm still long TBF, which is short the longer end of the curve because I think rates still do go up. Look, this has been driven 100%, 1,000% by multiple expansion. As I said before, that in a rising rate environment where the brunt of the Fed activity, the Fed tightening, has yet to be felt at all, really, it's a bad time to do it because you're not at trough earnings yet. That I don't mind multiple expansion. So, look.
So first off, I might disagree with him. We could be at trough earnings. To just say we're not at trough earnings, we could actually be in trough earnings right now. What this gentleman doesn't understand is the weighting in the S&P 500 and the NASDAQ 100 is, in 10 or 15 companies' hands, essentially. And I've gone through that on the main channel several times recently. The fact is the majority of those stocks will see their EPS go up and their margins increase in 2023 versus 2022. A lot of those companies were way overhired. They've done some major cost cuts. They're pulling back on just let's just call it the spend that the company's spending. And a lot of the inflationary pressures that were hurting them significantly in 22 are now going away. And so in this environment, you're going to actually see many companies start to improve their earnings as soon as possibly even Q2, right? I mean, I'm almost starting to think maybe even Q1's a possibility because I'm listening to some of these conference calls with some of these CEOs, and they're saying their business is coming in way better than they expected it to come in so far through Q1, right? And we're only a month and a little less than a month and a half through the year, but that's significant. And so, these are things you just have to take these into context.
Do I think it still has some more legs? Yeah, I think this is a good reset.
Tech, specifically on this growth trade, you think it has more legs?
Not right now, but I think it'll come back to it because there's an insatiable appetite to buy. I don't think it's the right move, frankly. I think you still want to be mostly in cash at this point because the second half is going to be miserable when you see the impact. But there'll be opportunities. I mean, you take a look at where Microsoft is and,
Okay, so this gentleman just said the second half is going to be miserable. He certainly could, but I'm sure this is the same gentleman along with all these other folks on CNBC that said the first half is going to be miserable, okay? So that's what these folks are all talking about. The first half of the year is going to be so bad, this and that, right? And yet, now let's push it off to the second half. And so it's going to be the second half this year. Maybe they're right, but I'm just saying, like, it's just funny how, it's like, oh, crap. Okay, let's talk about the second half of this year. They try to make these short-term predictions on the market time and time again, right? And it's obviously not going the way this gentleman, this gentleman comes on CNBC a lot, the Short Hills Capital guy, right? He comes on CNBC all the time. Listen to the way he was talking back in December. Come on, man. He was calling this market's going a lot lower. You need to be all cash, this and that, right? So, anyways.
That's come down from the highs, and you take a look at some of the others.
Well, I'm going to give you.
You take a look at the semis, which have been, incredible to run there, and they shouldn't have been. So you've had this money come in.
This man has been in the market for far too long to not even understand how the market works. The market doesn't care about what's going on today. The market cares what's going on tomorrow, okay? So this gentleman thinks because semis have been reporting disappointing earnings that their stock prices need to be at new all-time lows. Dude, these stocks got way ahead of that. AMD, NVIDIA, all those stocks, you can put them all into the same category. They got way ahead of this, way ahead of the slowdown. That's why the stocks went down, 60, 70% in AMD and NVIDIA. Look how much those stocks went down from the end of 2021 through, basically summer, fall of 2022. Those stocks fell 60 to 70%. Those are two of the greatest companies in the world if we're just going to talk about AMD and NVIDIA, right? Never mind all the other semiconductor companies. They got way ahead of this. But now they're starting to play because they're starting to run because basically the belief is semiconductor stocks are going to start coming back in terms of their earnings, in terms of revenue growth and those sorts of things in the back half of 23. And so if that's a dynamic you see, guess what? Then the market already played that out, right? The market's always playing in the future. And so, it's crazy to me that some of these folks that have been on Wall Street so long, like they still don't even understand the most basic concepts of the market's playing in the future. The market, like people that are playing AMD stock are thinking about the next, not everybody's a trader trying to trade in and out of AMD. Big money is investing. They're making big moves, okay? And those folks are the ones that really ultimately move these stocks in a major, major way over a period of time, over a 1 month, 3 month, 6 month, a year span, right? And those folks are looking out and they're saying AMD's earnings will improve as 2023 goes along. So we need to start piling into this stock now.
You had the post-tax selling season buying. Mm-hmm. You've had this euphoria about the beginning of the year, and then you had the FOMO, of which plead guilty to the end of it.
Dude, there's no FOMO. There's no FOMO in this market. These bears try to exaggerate everything. Like, there's some type of FOMO, dude. There's no FOMO in this market. Robinhood's lost 10 million monthly active users. 10 million monthly active users. There's no FOMO in this market. You hear anybody saying, you got to go all in, other than maybe, I don't know, Tom Lee saying 4,800? No. Still watch CNBC, even after this epic bull run. The majority of folks, they're starting to kind of go to the bullish side because they've been embarrassed by how good the market's doing, and they all predicted that we were just going to be down and out, and we'd be at 3,600, 3,500 in the S&P right now, right? And these folks are like, what do we do? And they're not bullish. There's no FOMO in this market. Like, turn on CNBC for a few hours. Watch these folks. You think they're all talking about, we need to go all in now? No, of course not, okay? And from the retail side, there's no FOMO as well.
Yeah, I think that the risk is to the downside.
I mean, in 5.5 weeks, Bryn, I'm just going to give you an idea of names that have run a lot. Meta's up 48% in 5 weeks. Coinbase is up 64%. Shopify up 39%. Teladoc up 39%. ARK up 27%. So I give you year to date, but then I also tell you what we've done this week because
many of those stocks are down like 85 million% since 2021. So it's like everything's relative.
maybe tells the story that we ask at the top of the show of whether the trade is rolling over, okay? This week, Coinbase down 22%. Shopify's down 9%. Teladoc's down 6%. Ark's down 7.5%.
Meta's going to be 350 plus within 24 months. So you can either buy Meta at 175, you can wait and hope it goes back to 150 or 140, and then get in it and ride it to 350, or you can just get it, right? You choose. It's up to you.
What do you think about that broader question of whether this euphoria that was all around this early tech trade is about to end?
So investors need to understand that on any day, 80 to 90% of the volume can be algorithmic trading or CTAs. And we had a massive, massive short covering at the beginning of the year, which put so much energy onto those exact names you just mentioned. So
where were they talking about this when the downside was going on? Where was this talk when the stocks were getting absolutely pummeled? And it made no sense why the greatest companies in the world were falling 50, 60, 70, 80%. The greatest companies in the world. Were they talking about the algorithms then? Oh, no. But now let's start talking about it.
some of those names maybe got overdone. Like a Facebook saying we're going to cut spending. Maybe it deserves to be up, I don't know, about 30% in one day or 25%.
Yep.
But here's what you need to understand. Stocks tell us what they think about the economy. And stocks are pricing in no recession, soft landing. Bonds, though, drive stocks. And within the bond market, the two...
Are they really? Why is Meta not at 400 then right now? Why is it not at 400?
Here is what you need to focus on. And so you can put this rally in high beta tech, overlay it with the 2-year, which has gone from November from about almost 470 down to the third week of January, almost 4%, maybe 405. And then where are we today? 450. Because guess who follows the Fed? Fed funds follows the 2-year. Fed funds follow the 2-year. And so I still think that although the Fed has come out and said they're data dependent, which is a plus because they're not so behind inflation, we are still, I think, at the mercy of the market saying, well, maybe Powell has more rates, and the cuts that were in the market earlier this year are now off the table. That's what's driving what's going on in tech and high beta tech.
I mean, the poster stock of all of this is Tesla, isn't it? Which you own. I mean, it was at $100, right? And it's at 200, okay? So and
it was at 400.
A few weeks, it went from 100 to 200, and today it's down 5.5%. So was that too far? Too much too soon?
And in a matter of months, it went from 400 to 100. Is that too much too far?
As Adam Jonas of Morgan Stanley is wondering today?
I think 100 was too low. I think it was too much too fast of the really jump off the cliff as he decided, maybe he tweeted he was going to buy Twitter and then he actually had to buy Twitter, right? That totally destroyed sentiment and positivity. As that starts to go away and that he did the price cuts in China, which is incredibly smart, because as much as we talk about EV sales in the U.S., globally EV sales in the U.S. is 9%. Europe is 24%. China is like 50 to 60%. And so he is really gaining traction in China. And so I think that is what people are seeing, is that was really smart to cut those prices. And so, yeah, it went from 100 to 200. It should have never been at 100. But maybe this is now the new price for it. It needs to digest itself. As you know, I bought it at 120, but I sold calls at 150. So I'm capped out at 160 because I got $10 because I thought it's going to take time. But that's what the market does.
Yeah. That's one of the reasons I don't really do that strategy, because sometimes you're basically limiting your upside. Sometimes these stocks can go on insane runs that you weren't expecting, right? And if you limit your upside, that's never fun to see your stock climbing like that. And it's like, oh man, I limited my upside and it just went up way more than I thought, right? So anyways, that's my opinion on that. I'm trying to do a fast today, so I'm probably crankier than usual, so I probably shouldn't even be reacting to videos today. I haven't drank anything, haven't eaten anything all day. I'm a little on edge, baby. Anyways, guys, appreciate you joining me as always. V-Day still coming up, 2 days, 7 hours until that happens. So if you want to enter in your info and have the deal shot to you as soon as it comes out, they'll be down there in the description. And also for everybody that's looking to join us in the Patreon or is already a member of the Patreon, join us in there. It is absolutely amazing. It's the best value you're going to get in the world. I appreciate y'all. Much love as always, and have a great day.